Selling your business is a major milestone, but it's also a complex process with legal, financial, and emotional challenges. You may have heard the statistics. Over half of all potential business sales fall apart during the due diligence stage, and only 15 to 30% of owners who want to sell actually manage to close a deal. And many owners wildly underestimate the time, preparation, and expertise required to navigate the process successfully. An owner with a staff that's already pushed to its limits with the day-to-day responsibilities of running a business is going to start to crack when the barrage of document requests from the buyer's council starts flooding in. And it doesn't let up for weeks or even months on end. Understanding these common pitfalls in advance and taking steps to avoid or mitigate them can mean the difference between a smooth, lucrative transaction and a deal fraught with delays, disputes, or regrets. So let's dive into 5 of the most common stumbling blocks that owners confront when selling their business. Number 1, inadequate corporate financial and governing documentation. Buyers want clean, organized financial records that demonstrate the business's profitability and growth potential. You'll be expected to share current and historical balance sheets, income statements, and cash flow statements at minimum. They also want to see that the most basic and fundamental corporate governance and record-keeping measures are in place. You shouldn't be scrambling to find, or even worse, creating after the fact, your company's articles of organization or articles of incorporation, governing documentation like bylaws or operating agreements, business licenses, stock certificates or certificated shares of membership interests, corporate resolutions or written consents relating to foundational changes to the company, or even signed purchase agreements and assignments memorializing any past transfers of ownership interests. Poorly documented finances or incomplete corporate records that call into question the good standing of the company can lower your company's valuation significantly and will scare off serious buyers who just don't have the patience to sort through that type of mess. But you can work with your professional advisors in advance to fix these things. Enlist your accountant to ensure that your financial records are accurate, up to date, and compliant with tax laws. Your CPA can also help you prepare detailed reports, such as profit and loss statements, balance sheets, and cash flow projections, going back about 3 to 5 years. You'll want to resolve discrepancies like commingled personal and business expenses well before listing your business as well. And the same is true with your corporate records. Your attorney can help you fix a lot of past mistakes and omissions, but the sooner you enlist her help, the better. Pitfall number 2. Overlooking the importance of confidentiality. If employees, customers, or competitors learn of a potential sale too early, it could harm your relationships or destabilize your operations. Naturally, you're going to want to use non-disclosure agreements, or NDAs, with prospective buyers and advisors. And even with those NDAs in place, it is generally prudent to limit the type and amount of information that you share about your company in the earliest stages of the process in order to protect your business's most sensitive and proprietary matters. You also need to carefully consider which members of your staff to tell and when. This tends to be where I see owners struggle the most. They typically do need to let at least 1 or 2 of their key employees know about the proposed sale so that those people can assist with the diligence process. But if the news escapes prematurely, it can cause gossip and panic among the employees, which is a massive distraction at best and results in an exodus of employees looking and leaving for new jobs at worst. So you'll want to keep the sales process discreet, announcing it only when legally and strategically necessary. Now, although that exact timing is ultimately a business decision, your lawyer should be able to help guide you based on any applicable legal requirements, as well as insights gained from past clients who may have elected to announce a sale internally and externally a little too soon or a little too late. Depending on the size of your company, the deal's term sheet may also have provisions regarding joint press releases or receiving the other party's consent prior to publicly disclosing the sale. Remember that although much of the term sheet simply sets forth mutual understandings but remains subject to negotiation, this provision probably is expressly binding, so don't breach it. Pitfall number 3, mispricing the business. Undervaluing your business leaves money on the table, but I probably don't have to tell you that that is not the problem that normally arises. A grossly inflated asking price can deter buyers entirely, and sellers typically inflate the asking price of a business by about 15% compared to what buyers are ultimately willing to pay. Now, don't get me wrong, as a seller, there's nothing inherently wrong with coming to the table with an aggressive position, especially if that's what your advisors have indicated is best. But if you are stubbornly unwilling to budge from a number that has no logical nexus to its actual value, simply because this is the company into which you've poured your sweat and tears for the past decade, and you have arbitrarily decided that that's what it's worth, you could be in for a difficult and frustrating journey. Plainly put, emotional attachment can cloud an owner's judgment about the business's worth. You may have an intuitive understanding of why problem X isn't nearly as pernicious as it seems, or why those 3 consecutive negative quarters 2 years ago are easily explainable by justification Y, but the prospective buyer does not. Even sophisticated buyers who are well versed in the industry and market and who have conducted extensive due diligence won't. And to the extent that they do, they necessarily have to take off those rose-colored glasses. This is so common that I'm not sure it's even possible to avoid the problem entirely, but there are a few steps you can take to mitigate this pitfall. First, obtain a professional valuation from a business broker, CPA, or valuation expert before you go to the market. Ask for a detailed breakdown, separating the business's goodwill or intangible assets like brand reputation from its tangible assets so that you can better anticipate where a buyer's appraisal may realistically fall. And even with this professional valuation at hand, it's important that you understand that industry benchmarks and how market trends can affect the business's value, especially as time passes from the original valuation date. Be sure that you've accounted for how the structure of this deal, that is, whether it's an asset sale or a stock sale, will affect your tax liability. And please engage a tax advisor early on in this process to minimize your tax burden and ensure compliance. Finally, listen to what the market is telling you and be aware of those advisors who may have mixed motives in revving you up and insisting that the business is worth more, despite every seller in the marketplace telling you that it's not. The fact of the matter is, you don't have to sell. If you truly believe that it's worth more than anyone is willing to pay, then maybe the rational thing is to hang on to it until the market's perspective changes. Pitfall number 4, failing to address liabilities and other potential deal breakers. Even if your business is priced right, buyers will conduct thorough due diligence, and undisclosed liabilities can tank the deal. These undisclosed liabilities could be anything from pending lawsuits to business debts or guarantees to environmental issues to unresolved tax disputes and so much more. If you simply didn't know about the liability or you forgot to disclose it to the buyer, this is going to raise red flags. How can we be confident in the way they operate a business when they're ignorant to liabilities that we managed to uncover through due diligence? And what other liabilities are out there that neither of us know about yet? And if your failure to disclose was due to what the buyer perceives as willful ignorance or fraudulent omission, trust will be shattered. In the unlikely event that the buyer decides to proceed regardless, you can bet that the purchase agreement will be stuffed with extra representations and warranties, indemnification provisions, a massive indemnification escrow, and a reduced purchase price payable over years rather than as a lump sum, so that the buyer has every opportunity to claw back amounts reflecting unforeseen expenses that can be attributed to or connected with your duplicity. The first step to avoiding this pitfall is don't commit business fraud. Don't make false representations in the purchase agreement or omit material facts. Indeed, my advice to sellers is generally to err on the side of over-disclosure because of the way most purchase agreements are structured. But before it even gets to that point, conduct a pre-sale due diligence process to identify and address anything that would potentially be distressing to a prospective buyer. Think of this as conducting your own internal audit, identifying and rectifying potential red flags before the buyer even digs in. Settle outstanding debts, legal disputes, or regulatory issues before the sale. Clearly document key assets, get your vendor contracts up to date, and make sure that they're assignable to the new owner. Resolve any ambiguities around intellectual property, like whether it's owned by you personally or by the company, and so forth. You may have to pay legal counsel to assist, but remember that every red flag a buyer spots is an opportunity for them to request concessions to the purchase price. So fixing it now is an investment with future returns. Finally, pitfall number 5, failing to plan for the transition. This pitfall will actually hit you twice. First, buyers often require transitional support to ensure business continuity, especially if the seller's involvement has been integral. The requirement of a transition services agreement, under which the seller commits to assisting the buyer for a predetermined period, usually somewhere between 3 to 6 months, but I've seen it as long as 2 years, after the sale to limit operational disruptions. It may only be a single line in the deal term sheet, but this is not reflective of its importance, and overlooking it can lead to disputes or even a failed deal. I suggest aligning expectations and negotiating a transition plan up front, sooner rather than later, if the buyer expects you, the seller, to remain involved in the business in any capacity after the sale. Will you be a consultant or an employee? For how many hours a week and at what compensation level? Are your transition responsibilities limited to internal advisory services and employee training, or are you expected to introduce the buyer to key industry relationships as well? It is a nightmare when the parties each spend tens of thousands of dollars going through the diligence process and negotiating a purchase agreement, only to realize at the 11th hour that they are drastically misaligned as to what the seller's transition responsibilities will be. Now, the second place this hits you, the seller, is what comes next. The purchase agreement or transition services agreement may require you to sign a non-compete clause restricting your future business activities. Federal and state laws around this do remain in flux, but as of the time I'm recording this, if you are an owner and the non-compete clause is reasonable in scope and duration, under just about every U.S. jurisdiction, you should expect that that clause will be upheld. So starting a competing business the next town over might not be an option. What are you going to do with your time now that your career and identity are no longer connected to this company? This is not a rhetorical question. I need you to be able to answer this with some degree of specificity and confidence. The owners who have no clue are almost always the same owners who profoundly regret selling their business, no matter how spectacular the purchase price, a year or two later. Selling a business is an intricate process that requires financial, legal, and emotional preparation. And please don't discount the emotional factor. I will tell you this, irrespective of age, gender, or race, at some point in the selling process, well over half of my seller clients have had a moment where they've broken down, sometimes to the point of tears, because the process is taking longer than they thought, it's more work than they thought, they're not going to get as much money as they thought, or they are freaking out over what is going to come next. And sometimes it's all of those things. Now, it's my job as your attorney to help you get as much money as you realistically can, as quickly and smoothly as possible, and even to help guide you to your next big thing and get you started on the right foot there. But even when all of that is going perfectly, this is a huge life change, and you're leaving behind something that's been a huge part of your identity for many, many years. For some people, it's as emotionally fraught as selling your home and moving across the country away from your family, or even getting a divorce from the person with whom you've raised a child for 18 years. So give yourself some grace. And please don't rush the process just because you want to be done with it. By preparing yourself, avoiding these common pitfalls, and seeking professional advice, you can maximize your business's value and walk away with confidence. If you're thinking about selling your business, start planning now. And as always, consult with a trusted advisor to guide you through the process and protect your interests as you move to this next stage of your career and life.